Welcome to The Explainer. Today, we're breaking down the practical, step-by-step process of buying and selling stocks for beginners. You hear so much noise about the stock market, the hype, the speculation, those fast-moving tickers on the news, but the actual physical mechanics of how you buy a slice of a business, it's honestly incredibly straightforward once you just learn the system. So we're going to clear away all that confusion right now and focus purely on the practical process you need to safely navigate the market. To get there, we'll be moving step by step through 4 distinct phases: preparation, translation, action, and finally, resolution. It's a question that honestly intimidates a lot of people. You probably already know that a stock represents partial ownership in a publicly traded company. When you buy a share, you own a tiny piece of that business, for better or worse. But actually acquiring that share, getting it into your hands, that is where people get stuck. So let's outline exactly how to practically and safely execute a trade.
Let's kick things off with phase 1, preparation.
Obviously, you can't just walk onto the floor of a stock exchange with a handful of cash, right? You need a gateway. Step 1 is opening an account with a regulated broker. A brokerage account is what actually allows you to interact with the market, and getting it set up just requires verifying your identity and your tax info. Step 2 is funding that account by transferring your money in. But Step 3 is where your real work begins: research. Investing involves real risk. You absolutely must thoroughly understand the business you intend to buy a slice of before you ever even think about clicking a button. Moving right along to phase 2, translation. Time to learn the lingo. Before placing an order, you have to learn the market's vocabulary because misunderstanding it can lead to some really costly mistakes. It starts with the ticker symbol. You can't just type in a company's name. You have to search for its unique alphanumeric code. This brings up the correct pricing and guarantees you aren't accidentally buying a company that just happens to have a similar sounding name. This is your precise target identifier. Now let's look at the bid. This represents the demand side of the market. Think of it like a giant auction. The bid tells you the absolute maximum amount of money that prospective buyers are currently offering to pay for shares. It's the highest price the market is willing to bear at that exact millisecond. On the flip side, we have the ask, which represents the supply side. This shows exactly what current owners demand to part with their shares. If you're looking to buy, this is the lowest price a seller is currently willing to accept from you. It's basically the floor for anyone holding the asset who wants to cash out. And that brings us right to the spread, which brilliantly illustrates the gap between buyers and sellers. The spread is literally the monetary difference between that highest bid and the lowest ask. For a transaction to actually happen, someone has to cross that bridge. A buyer must step up and pay the ask, or a seller has to step down and accept the bid. Without that compromise, no shares are changing hands. Okay, phase 3, action. This is where we execute the trade. With the vocabulary clear, we reach the climax, actually navigating the market. And timing is everything here. Taking the New York Stock Exchange as our main example, the market operates on a very strict schedule. The core trading session runs from 9:30 a.m. to 4 p.m. Eastern Time. While early and late trading sessions do exist, liquidity, how easily a stock can be traded, and volatility swing wildly outside of those core hours. For a beginner, sticking strictly to that core session is definitely the safest environment for executing a trade. Now pay attention here, because this dichotomy between the two most common ways to buy a stock is absolutely crucial. First, a market order. This is an instruction to buy immediately at the best available price. It prioritizes pure speed, but here is the catch. The execution price is not guaranteed. In a really fast-moving market, you might pay a notably different price than the last quote you saw. On the other hand, a limit order is an instruction to buy at a specified price or better. It aggressively protects your price, but it risks never executing at all if the market doesn't drop down to reach your limit. Let's add one more vital tool to your tool belt: the stop order. A stop order sits dormant until the stock drops to a specific stop price that you set. Once triggered, it instantly turns into a regular market order. This acts as a safety net to help manage risk, say to trigger an automatic sale and prevent further losses if a stock unexpectedly plunges. But remember that core trade-off we just talked about. Because it converts to a market order upon triggering, your final execution price is absolutely not guaranteed in a rapid sell-off. By strictly following these execution steps inside your brokerage account, you keep yourself grounded. Step 4 of our overall process: pull up the exact ticker symbol. Step 5, carefully choose the order type: market, limit, or stop that best fits your strategy. Step 6 is crucial, guys.
Pause to review the total costs, the number of shares, and the real risks involved. And finally, step 7, submit the order. Using this exact checklist forces you to act deliberately, entirely avoiding trades based purely on hype or fleeting emotions.
Finally, we hit phase 4, resolution, monitoring, and eventually exiting. So your order is executed. Step 8 begins. Remember, investing involves real risk. While a company's long-term stock price is ultimately connected to its actual business performance, short-term stock prices swing wildly based on news, liquidity, and general market sentiment. Your job as a shareholder is to monitor the underlying business, not to panic every single time the line on the chart wiggles. Overtrading and emotional knee-jerk reactions, those are some of the biggest pitfalls for beginners. Eventually, the time will come for step 9, exiting your position. Selling your stock beautifully mirrors the buying process, requiring the exact same discipline. You review your holdings, decide precisely how many shares to unload, and then you've got to once again carefully weigh your order types. Do you need a market order for an immediate exit, or a limit order to guarantee you don't sell below a certain threshold? You make your deliberate choice, review the expected proceeds, and confirm the execution. Because here's the thing, the stock market is not a place to get rich quickly. It's a meticulously structured financial system. It gives you the brokerage platforms, the ticker symbols, and the precise order types to control your entries and exits. But the ultimate variable is you. So I'll leave you with that vital question to consider before you embark on your own investing journey. Thanks so much for joining this explainer, and keep learning.